Welcome back. You're watching a special edition of Indianomics based on the GDP numbers for FY25 that have just been announced. The numbers are an upside surprise. Both the fourth quarter numbers and the full year numbers are better than the polls thrown up by CNBC-TV18 and other agencies. I've been speaking with economists Kaushik, Suvodeep, Rakshit, Abhishek, Upadhyay and Aditi, Nayar. Gentlemen and Aditi, thank you very much for waiting on, for your patience. Abhishek, first cut, is there a likely upside risk to your numbers, growth numbers for the current year?
Latha, we are taking balanced risk. Again, I come back to the global growth viewpoint. This year, exports would have contributed roughly 80 to 90 basis points. The additional growth in the last fiscal year.
That's correct.
FY24 exports growth was around 2%. Last fiscal, we got around 6% growth, which was a meaningful growth support. If we see a sharp slowdown here, then it will be difficult to get stronger growth. That said, assuming US economy doesn't enter a recession and global commodity prices stay soft, other factors are more benign, clearly. Two points here. One, we are thinking underlying growth at the start of the current fiscal is 6.5%, but it could well be stronger. In the past, what we have seen is whenever the informal sector of the economy is doing well, the tendency for growth is more towards upgrades rather than downgrades, which is possible again. And second, consumption has been the key weak point for us all through, last few years. But what we are seeing now is rural demand, which is the bigger part of the overall consumption pie, has started to do well. And with additional tailwind from a weaker inflation that we anticipate this year, it is likely consumption growth could surprise higher. Finally, urban consumption, which is more global demand sensitive, but it has some tailwinds, as Kaushik mentioned, from income tax cuts, as well as the interest rate cuts from RBI, which should support that part of the economy. So the one way I'll put this is the downside risks at this stage appear limited, assuming global growth is not very, very, very weak.
Yeah, that's a nice way to put it. Let's not speak about upside risks when there is still a big global uncertainty. But Suvodeep, it'll be very difficult to argue for 4 cuts with such a growth, wouldn't it?
Yes, Latha. Argue for 4 cuts, it depends on the perspective, right? When we say 6.5% growth, from a policymaker's perspective, is it a good growth or a bad growth is a good question to ask. If you aspire for a 7.5% growth, and if you have inflation which is favorable, and when I say favorable, it is below your central target.
Mandated, yeah.
Yes. And then I think that's the point where you try and push growth as much as you can, because eventually a point will come cyclically. And that's the nature of cycles, that you will have to move the other side. But when you can push for growth, when you can support growth, you will work with the inflation growth mix that we have. Now, the point is that if you have a 3.5% growth in FY20, 3.5% inflation average, which is our estimate for FY26, and even if you have, let's say, 1.5% as a natural or a neutral rate, you have space to cut rates. If not by 4, you can have another 3 for sure. But my point is that, whether it's another 75 bips cut or whether it's 100 bips cut, the context is, if we believe that 6.5% is good enough, then maybe 50 bips. But if we think that 6.5% is not what the potential growth of the country is, and the monetary policy, along with the fiscal policy, has to move towards at 7%.
Got it. Sorry, unfortunately out of time, so I'll have to rush the comments from Aditi and Kaushik. Aditi, take from Reserve Bank, how many cuts?
So, Latha, I think we also need to focus on the fact that when we look at the annual GDP growth data, there is a very sharp slowdown between FY24 and FY25. Now, with CPI inflation averaging close to 3.5%, which is our forecast, and several months ahead where we want to have sub 4% monthly prints coming in, I do think that we could be in for another 75 basis points of rate cuts. 50 is, I think, a minimum. 75 is certainly possible at this point.
Oh, 75 possible. Kaushik, last word. You have the last word from RBI.
So Latha, since I'm the most optimistic on growth, therefore I would say only 2 more rate cuts. And that also 25 basis points in June, after which in August, I expect RBI to pause and they give the final rate cut probably on 1st October in the October policy, where the policy rate comes down to 5.5. Remember that RBI has infused so much liquidity, and with this dividend transfer, your effective easing has happened already another 25 basis points. So in June, if RBI cuts rates, you're probably going to see 50 basis points actual rate cuts because of liquidity. And I don't think you need to go below 5.5 on the repo rate. As I told you before, in 2019 calendar year, our GDP growth was below 5%. That is the time when RBI had cut policy rate to 5.15. Today, we are saying that growth could be 6.5 or between 6 to 6.5. Why should the repo rate go to 5.15? So I think 5.50 is the terminal repo rate.
Fair point. Actually, you're not alone, Kaushik. I think Abhishek shares that point of view.
Latha, but with a pause in August, I think people are just doing extrapolation every week.
At the moment, the market also may be on your side, because the bond yields have moved by 5 basis points after the GDP numbers have come. So the new 10-year is at 6.22%. It was at 6.17 yesterday. And the old 10-year, which is really the 9-year, has gone up to 6.25, if I'm not mistaken. So clearly, the market believes that the good growth could put a leash on Reserve Bank's largesse. That's it on this edition of Indianomics. Kaushik, Suvodeep, Abhishek and Aditi, thank you very much for analysing the GDP numbers.